Good morning, everyone. It is 8:40. Welcome back to CW Iowa Live. Lou and Jackie here, along with a good friend, Michael Jankins. We're talking about some things that you should be aware of if you want to try to avoid bankruptcy. And this morning's topic is a very unusual, because I don't think some folks have considered this.
Well, something else we're not aware of what's happening with our health care is they're trying to get a new bill passed through really quickly, but never even thought of the correlation with health care and bankruptcy. But you're going to kind of show us how that is connected this morning.
I think so.
Yeah.
So everybody kind of realizes, I think most people, that if you don't have medical insurance at all, that you're at risk for having large medical bills, and that can be a cause for many people to have to file bankruptcy just because of that. So that's pretty obvious, and so I don't really need to spend a lot of time with that. But the thing that also is important is, so there are people, a large number of people that I visit with that have health insurance. It's just not very good. Mm-hmm. So they'll have an employer-sponsored health plan, and because they want to keep the premium low, they will have a really high deductible, maybe $5,000. And in many of these plans, the insurance company doesn't pay along the way too. The insurance company doesn't pay anything until a person's had bills of over $5,000.
That's a lot of money.
It's a lot of money.
Yeah.
And so many people can't afford to pay these bills. And so, unfortunately, some people have choices. They have employers that have several plans that they can choose from,
right.
And many people will opt for the plan that costs them least amount of money, and almost it's not even worth having, because when you get these medical bills, you can't afford to pay them, so you just don't. And these things start to clutter up your credit. When you have these medical bills, if you don't pay them, after a while, they send them to collection agencies. Then the collection agencies report these things on your credit report. So everything else can be going great. You're paying your car payment every month and your couple credit cards, but lo and behold, all of a sudden these $50, $100 bills that you didn't pay at the different clinics and hospitals, all of a sudden they start checkering up your credit report, and your credit score starts going down and down.
Because some of these insurance plans, they don't cover your office visits or the tests that the doctor might want to do for you, and so those just start piling up.
Exactly, and these office visits could be relatively expensive. I mean, if you got to pay $50 a pop, and you don't have a bunch of extra money, and then you got to go for a couple tests or x-rays and things, or CAT scans, these things can start adding up into the thousands of dollars, and so this is all over your credit report, and your credit score is going down. So the big thing here is, what's going on with your credit score in relationship to all of the other things that you might need to pay for in your daily life. And that's where it really starts to kind of get risky, walking around with bad credit. And, the unfortunate thing is, it's one thing if you voluntarily incur a loan or get a credit card, so you know you're incurring these credit obligations and you were planning for them. But these medical bills aren't always things you were planning for. Mm-hmm. I mean, I suppose if you go into the clinic because you got a bad cold or something, I guess you plan on that. But sometimes people get stricken with something that they weren't planning on, and
right.
It gets really expensive. And if they either have no insurance or one of these really poor insurance plans, all of a sudden they're just going to have these thousands of dollars of medical bills. And for the moderate income to lower income person, they may not be able to handle these with the other obligations they've gotten raising their family. So I guess the first thing I would say is, if you have a choice, go ahead and pay the extra $100 a month in premium, or even if it's $150, or not premium, but in what you have out of your employer-sponsored plan,
right.
Opt for the better plan, at least for your single coverage. Realize that if you got family plans, those can really be getting expensive through the employers. But for many people, they have other options to insure their kids. In Iowa, there's a plan called Hawkeye, and there's many situations where even though you have insurance at your employer and you can get on it, you can get your kids insured through Title 19 or Medicaid through the state as well, so that you can still keep your insurance costs down for yourself. Now, the way these the bad credit can start to affect you and potentially drive you into bankruptcy, besides the fact that you're building up all these medical bills that you can't pay, is some of your daily expenses start to increase. If you don't have good credit, now you start having higher insurance rates. I started doing some research and found there was an article in Consumer Reports, I think in 2015, they published a survey and they had the whole country, and so when I checked Iowa, they compared what people's insurance costs would be if they had good credit or bad credit,
right.
And it was rather shocking. So everybody in the survey has a clean driving record. So usually you think you have a good driving record, well, you get good insurance, and that isn't the case. So
you talking auto insurance?
Auto insurance.
Auto insurance, okay.
So when they compared a person with a clean driving record with a good score, and they were saying that if you have a poor score compared to an excellent score, you would pay $881 a year for the good credit score and $1,837 for excellent credit score. Excuse me, vice versa. 881 if you have a real good credit score, and if you just have good or fair, 1,800.
Wow.
So there's a big difference on the credit scores. Now, what's even more shocking is in this survey, a person that had a clean driving record and an excellent credit score and a drunk driving on their record, which you would think would be the most horrible thing,
right.
They found that they would pay about $1,489 annually for insurance. And then they compared that to somebody that had a clean driving record and a poor credit score, and they paid $1,837, so they're paying $400 more than somebody with a drunk driving on their record.
Wow. So the credit score is the answer when it comes
crucial.
to this. Yeah.
And so all these medical bills that you could be having cluttering up your credit record, and even if it's not tens of thousands of dollars, if you build up many things in collections, then your credit score just keeps going south, and then all your other living expenses start going up. So
now, is there a certain threshold that once you get to, if you have a certain amount that you owe, that your credit score starts going down?
I don't really know if there's a correlation. I know it's important that you be paying everything on time.
But the payments.
Right.
And if you're in collections and you're having medical bills on your credit score, it's because they're in collections, because the doctors and hospitals generally aren't making the reporting. It's only getting done once they've gone to a collection agency and they're doing the reporting. So these big differences in your car insurance can make the difference in other things that you can afford, and it can get you in danger of possibly having to be in a bankruptcy situation. And the same is true with homeowners insurance. So your house payment can be big enough the way it is, but if your credit starts going south and you go from excellent credit score to fair, there's been another survey that was done on time.com just back in May, and they showed that you could have potentially over 100% difference on your homeowner's insurance premium with the difference from a fair credit score to an excellent one.
Wow.
So just your insurances alone could drive your living expenses up so high that it wouldn't take much if you're just teetering on things to be pushed into a deal where you can't afford to pay your other payments now. You can't pay your credit cards that you were managing. Maybe you can't make your mortgage payment because things are getting too high. And so again, you're at risk for bankruptcy. Now, another example of how credit scores can really affect you is when you go to get a loan for your car. People need cars all the time, and most people have to finance them. So I ran a little bit of an illustration for just a common purchase. If you take somebody that goes and gets a relatively new car for $25,000 purchase price, that's not a Ferrari or anything. That's fairly average for a pretty new car. If you get somebody with good credit, maybe they're getting a 4% interest rate, which I don't think is uncommon right now for a new car. Well, somebody who's got all these medical bills that are unpaid and in collections on their credit report, and maybe a few other things, they might be looking at somebody's subprime lenders, and they could be looking at an interest rate of 21%.
21?
21%, and sometimes it's a little bit higher. So there's a big difference in what a person pays.
So what are people paying if they have good credit as opposed to have that prime interest rate?
So if you were paying 4% on this loan, and we're going to assume a 72-month loan, which again is fairly common, that's a 6-year loan, that seems to be the norm, you would pay $391 a month if you had good credit and you were on a 4% rate. Now if you were on this higher interest rate, 21%, you'd pay $613 a month instead of $391. So that's a really big difference. And you take all these other things that have harmed your credit, your insurances are going up, auto insurance, home insurance, and your car payment, and all of a sudden your living expenses are hundreds and hundreds of dollars more than the same person who was able to keep their credit good because they didn't have all these medical bills in collection. The amount of interest that you would pay in that loan,
this is mind-blowing.
It's incredible. So for the good interest rate person, you would pay $3,161 of interest at 4% in this 6-year loan. For the unfortunate individual that paid 21%, you'd pay $19,165 of interest for that same car. You could almost buy 2 cars just because of the interest rate.
Unbelievable. And that can show you how it's easy for someone to go into bankruptcy and how it's
Absolutely.
all
tied
together and correlated together.
So all these factors just kind of converge together and can basically push somebody over the financial cliff, and if you're not careful.
So the advice from a bankruptcy lawyer:
try to have a quality health insurance plan.
even if it costs you more.
In the long run, you'll be in a much better position.
Be ahead.
Wow. All right. If people want more information on this, I'm sure, Michael, this is the first maybe people are even making this connection in their own minds. And I know it is coming up where you might be able to change what you have on your policy at work. So get that implemented now. But if they want more details or just to talk to you about their personal situation, how can they get in touch with you?
You can reach me at 255-1855. Find us on the internet at www.iowa-bankruptcylaw.com or follow us on Facebook.
There you
Wonderful.
go. Thank you, Michael.
Thank you.
Good to see you.
Important discussion today.